All right, welcome Real Estate Hustlers podcast. I'm your host, Josh Appleman. Today we're joined with Mitchell Rice. Mitchell is principal at Elkstone Capital, an Idaho-born real estate private equity firm. 451 doors, around 45 million of assets under management. Converts hotels to multifamily, focuses on value-add multifamily and self-storage, with a target of 1 billion of assets under management by 2032. Mitchell, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Yeah, thanks for having me, Josh. Yeah, I mean, you pretty much covered it. Idaho native. I moved to Utah in about 2017 and went to school at Brigham Young University, studied real estate finance, ended up working for the for-profit real estate investment arm for the Church of Jesus Christ of Latter-day Saints. So if you've heard of the Mormons, they have a pretty sophisticated fund investing in both public equities, bonds, and commercial real estate. And so I was an analyst at that shop and on the development team. So got to be a part of the development of about $500 million worth of real estate, including warehouse and logistics, build for rent, multifamily. And then, about 2 years ago, branched out, started Elkstone Capital, and it's been a lot of fun.
Nice. Very cool. Yeah, and you've accumulated quite a few doors within the past few years, so that's cool. Tell us about your first deal on your own and how that came about, how you found it, funded it, and the business plan.
Yeah, so the first deal was a co-GP with a group that I had done some intern work with many years ago. And they reached out to me while I was still in my church position. And, they had a deal in Tennessee, so 207 units. A suburb of Tennessee, value add, 1975 vintage, and they needed help on the raise. So they had already taken an extension. Earnest money had gone hard, and it was a pretty big chunk. My memory serves me right. It was around 200 to 300 grand worth of earnest money hard in the deal. And so I went to work and just started dialing the phones, making calls, and I was able to help get half of our equity stack on that deal.
Got it. And those calls were from people that you had built relationships up through your previous career?
No, because with my previous career, we actually didn't raise equity or debt. So It was all unlevered, and the cash was all internal. We did all cash deals with internal funds. So I kind of had to start from zero, and I started with my network first. And my goal was, or my strategy was, let's reach out to business owners, somebody who's ran, scaled, or exited a company. And that's what ended up working for that particular raise.
So the church, is that from donations from these buy properties with cash via donations?
A portion of it. Yep.
Well, what's the other portion?
I mean, it all goes back to donations. If you go back far enough, hundreds of years, Father Tanner or somebody give a good donation, and that started off the investment fund. And now they try to roll those funds back in and continue to recycle those funds. But yeah, also a portion of church donations goes towards the investments.
That's interesting. That is there's a big play with being a charity and owning multifamily too.
Definitely.
That's a pretty good hedge.
And part of the goal of the church with that is to have a reserve fund to operate the church for 10 years if crap really hit the fan. So if all inflow stopped coming in, continue to build church meeting houses, temples, fund missionary work worldwide. So that is what it comes down to, and that is the ultimate goal of the church and why they invest in cash flow assets.
Yeah, very cool. So, all right, your first deal out of the gates, you made the deal pretty much happen by raising the capital. Do you syndicate all your deals, or are you doing deals just solely on your own, or what does that look like?
I love to co-GP. The hotel conversion we recently did as well. It was a co-GP with a group named Hotel Shift. And then, we're always actively underwriting our own deals, but I love to co-GP when I can, get strengths that I don't have, get a sponsor in the GP who has full cycle deals and just more experience, because obviously we're very new, get somebody who has good asset management experience. And, I'm fine putting my ego aside and letting people know that, yeah, I don't have 100% of the skill set to do this. And anybody who does jump into syndication, they'll learn that pretty quick. You cannot do this by yourself. You have to have a great team.
I think if it's owner led, if the company's owner led, the success is it's so much greater odds because of the just the amount of involvement that an owner will give something versus passing the baton from one to the other. So,
Yep.
and I think that goes into your underwriting, and then your conversion strength is that you're leading the charge on what your underwriting is. You're not going to go and balloon it out, and then hopefully it works. Hopefully your property management company makes the dream come true. Tell us
Right.
about your underwriting and what that looks like.
Well, yeah. So we hired a couple interns this year. So Morgan Menlove, Riley Curley, they've been awesome, and we underwrite multiple deals every week. So we actually just won LOI on a property in the Midwest, and it's taken us 5 months of underwriting weekly to get that deal. Um, it, in an environment like this, we just have to make so many offers to get the pricing we need on a deal to make it pencil. Um, Preferably we want to buy something that, above the cost of debt as far as the going in cap rate. So if I can buy, institutional multifamily at a 6 cap right now, that makes me really excited. Hopefully it's the rents are below market. We can, whether it needs a value add or it's a core deal, like this deal we just won LOI on is a 2020 vintage. So it's brand new. It really doesn't need anything. But we recognize that the rents were about 10% below market, 10% loss to lease. So we like looking for things like that. Obviously, there's a lot of qualitative factors we look at when choosing a market. What deals we take, population growth, demand drivers, GDP. Yeah, so there's a lot that goes into underwriting. Pulling rent comps, sale comps, understanding expenses. Getting a budget from a good property management company. Yeah, we're pretty conservative on underwriting.
Yeah, it's especially right now. I don't see rent bumps being huge. I see them plateauing, and then uh, not necessarily coming down, but things got a little high pretty quick. And now I think that you kind of you're getting some downward pressure with affordability.
Yeah, Utah especially. I've been trying to find a deal here because this is where a lot of our investor base is. So for the past 18 months, I've been trying to win a deal here and still haven't been able to. Everything's so expensive, and there was negative rent growth the last 2 quarters of last year. First quarter this year finally kind of started to break even again. So yeah, what I have noticed is it's very market specific. Some submarkets are still hot, some are very cold. So market does matter very much so.
Yeah, yeah. As long as the market is steady, it's got steady Betty. I'm out of Cincinnati, Ohio, so this market's been steady Betty for years and years and years.
Yeah,
Fortune 500 companies, steady employment. It's just a good place to live. You don't have your erratic upswings or downswings like some of the Sunbelt cities do.
definitely. Yeah, the Midwest is kind of an exciting thesis right now. We've been looking over there at properties as well. So I think Detroit last year had some of the best rent growth in the nation. And when you think about a Detroit,
Yeah,
it's, as far as real estate goes, you kind of think of it as the armpit of the nation, but the Midwest is definitely making a comeback.
I would say Detroit would have pockets, just like any other
Definitely.
city. But those pockets are pretty small, but you just got to
Definitely.
find the pocket.
Yeah,
Let's
I'm not endorsing it by any means, but just making a point that yeah, it, it's making a comeback.
Well, it's just like anywhere else, though. If you have a major employer that just shuts the doors, gets out of town, I mean, it's going to of course negatively impact the community, and that just happened a lot in Detroit. And
Hmm.
I mean, you'll get. I think there was a paper mill that shut down in Youngstown in Cincinnati, and it's like, well, it's a paper mill. Everything's going digital. Those kind of things you're going to see that. That's where the cities need to diversify and make sure that they're bringing in new companies to kind of to bring everything up to date with employment. kind of leads into AI. Have you been following AI and seeing what the landscape on that might look like?
As far as AI in real estate
In general,
in general,
I think it's going to impact everything, including real estate, including jobs, including just anything
definitely.
and everything.
Yeah, yeah. I'm no expert, but I think things are going to become more efficient, and that it definitely will cut jobs in some areas. Um, yeah, it's crazy how fast it's adapting and evolving. So it'll be curious to see where we end up in 5 to 10 years.
Yeah, and it's just getting ahead of the curve and seeing what can it impact. How we dropped our portfolio and kind of seeing the impact study of AI, and we've got workforce housing. So what does
Oh,
that
okay.
look like on a broad scope on our areas of residence? And it just gets you ahead of the curve. We do a lot of subsidy. Not a, I mean, 37% of our portfolio is subsidy, which is fine. I mean, it's steady income. It's good.
So is that low income housing tax credit, or is that Section 8?
Section 8. So
Okay.
it's just adding a coupon on top of. It's not 100% subsidy. So we still want the resident to have skin in the game, so to speak. But at the same time, it's kind of hedging against what does universal basic income look like? If there's no skills left for that specific job type. So um,
Yeah. Yeah, we're looking at starting a Section 8 fund right now, actually. So it's a super compelling thesis.
I think it needs to be a part of a real estate portfolio. I believe, of course, you need your market rate tenants too to keep pushing your rents, because your market rate will actually push your Section 8 rents up and comps. But
Yep.
you got to have that piece. What does this look like if AI does become very, very progressive and some of these jobs that were relied on are no longer available? What does that look like? I think there's going to be jobs created. It's just who can adapt to those type of jobs that are being created. It's not everyone
Definitely.
can plug in a workflow that can build an AI agent that then communicates to another AI agent through an API. And no, there's a huge learning curve. So it's just
Yeah.
keeping ahead of the trend and see where it comes.
Is that what you're trying to do with it?
We've got, I mean, anything that we can use to put in front of our people that helps. I'm going to say just silence the nonsense calls or help give back time. We will, for sure. Phone AI, just answering calls, submitting tickets if needed, work order
Yep.
management, reminders. I think those high level things can be taken care of without human interaction. And if there's a level 2 support, whatever kicks back to us. Um,
Yeah, that
but
makes
at the
sense.
same time, you can take on a lot more and not need to add a lot more people. Kind of like the adage: the more work you have, the more people you need. Then the more people you have, the more work you need. It's a it's a rat race to grow. Whereas this, you can just plug in smart workflows and grow without destroying your bottom line or
Yep.
get on the rat race. But yeah, those things for sure. But at the same time, it's um, how can you leverage your people's time better and then grow at the same time? So make it make sense.
Yeah, that makes
Um,
sense.
you're on the track to get to $1 billion here within the next $1 billion worth of assets under management. What is what do you where do you see your assets being as far as geography, and then how do you feel like you're going to get there?
Mountain West, Midwest, and Sun Belt. Right now, the particular areas of focus are Mountain West and Midwest. And how we're going to get there is just being disciplined, setting annual goals. So this year, the goal is to get to 1,000 doors. And the first 2 quarters have been slow, I'll say that. But like I said, we've got that 160 unit that we just won LOI on, working towards the PSA. Got another 70 unit development here in the Mountain West. And then that Section 8 fund, looking at potentially another 80. So that'll get us to 320 more, hopefully by end of Q3, if we can capitalize all of it in the time frame we would hope. And then it's then we're one deal away from that 1,000 number by end of year. So I think to hit a goal like that, it just comes down to discipline. It's making sure you're submitting enough offers each week, underwriting enough deals, relationshiping with brokers, and setting annual goals that also break down into monthly goals. I love the book, The 12-Week Year. I don't know if you've read that one, but his philosophy is there's actually 4 years in a year. If you break each quarter down and you pretend, you kind of psychologically trick your brain into thinking each quarter is its own year. And you can achieve almost as much in a quarter as a typical year if you set goals correctly. So I think that's one way I'm trying to hit that goal.
Are you familiar with EOS?
No, tell me.
Entrepreneur. It's read the book Traction and
Okay.
implementing EOS Entrepreneurial Operating System. Same
Okay.
exact thing. You just top down, setting your goals and then into daily tasks, and really helps engage your team. But EOS is used by some of your major companies. Look it up, but I could see you benefiting from that as well. It's what I use, and
Okay.
just hitting those quarterly rocks, targets, and setting those goals. It's
Definitely.
if you can see it in your head, you can have it in your hand. So you got to see it first.
Yeah. Yeah. I'm a big believer of vision boards
Yeah.
based on what you just said. Yeah, I make a vision board every year, put it on the wall, and it really makes a difference when you see that every day.
Yeah, I mean, it doesn't take much, but if you can see it, and now you've got tangible evidence, you just got to go out and get it. It makes it work. So you all use third-party property management for your portfolio, is that correct?
Correct.
Got it. What do you look for in third party, and are you growing with the same company, or do you have to stand up with a new one every time you acquire a property?
Yeah, every one of our deals so far are in different locations. So Tennessee, Texas, and Idaho. And then again, the next one's going to be in the Midwest. So hopefully we get to a point where, we're buying centralized in one location. We get some efficiencies there. But yeah, so far we've just had to create new relationships with third parties everywhere we go.
Got it.
And
Yeah.
also a lot of the times our co-GPs have those relationships, which helps because, if I underwrite a deal in South Carolina that I really like, okay, who do I know? Who's a GP in South Carolina who operates boots on the ground in that market? Because we're in Utah. I'll call them up. Hey, have you seen this deal? Yeah, we have. We're going to offer on that as well. Okay, perfect. Let's go submit a joint offer. That's exactly how we got our last deal.
Yeah.
Hopefully that answers your question.
Yeah, that makes sense. It can become very fragmented when you have a lot of different personalities operating in different styles, different systems that you log into just to get the same metric. Unless you back it up with these are our expectations, these are reports that we need. And I'm assuming they give you access to the systems that you log into. So you do. So you're also converting hotels into multifamily. Can you touch on that and what type of hotel assets you look for to convert?
Yeah, so the last one we did didn't even have a flag on it. It was a non-brand hotel, and the owner was preparing it for a flagship. I believe it was going to be a Residence Inn at Red Roofs. And so it needed to be brought up to their spec level. So he went and put in about $2 million into the property. So about $10K per door. It was a 100-unit motel. And then he kind of ran out of money and got tired, and we found him, and we gave him some of the GP, negotiated a seller finance deal. So we carried half the financing. And we were pretty much able to take over a turnkey asset. Besides, we had to install a fire suppression system, which that's almost always one of the things you have to do with a conversion like this. What's up, Nate? I just saw Nathan Bird's message. And then a couple other code items with the city. We had so the balcony railings were spaced too far apart. So to overcome that, we just came in and we welded in additional spindles in between each. And it ended up being a really simple fix. So yeah, what we look for in conversions, often those are the projects. You have to install fire sprinklers. A lot of the times when you convert an asset, you're going to have to individually sub meter. So usually it's on one master meter, and almost every jurisdiction I've talked to, the city wants it to be individually metered.
Why is that?
That is a great question. I actually don't know the answer.
because I don't know that it would make sense for like to the city or not, whether it's as long as the bill gets paid.
Yeah, I wonder if it comes down to like fair billing rights with water, and it's easier for them to see and to know that tenants are being billed fairly.
Yeah, I'm
Maybe
not
it's
sure.
transparency. But yeah, it's a good question, but that's been a reoccurring theme from what I've seen.
Yeah, because the property we were talking about before, it's 144 unit. It's all master metered, so we bill back, set them out each month, just help cover the utility expense.
That's great. And the city was fine with the master meter?
It's already master metered, so it's not really even a question we asked, and not
Good for
planning on
you. Good
asking.
for you. There you go. For some reason, that's come up in all of our conversations with cities. So maybe I should just try to avoid
Well, and
bringing that
even
one up.
our multifamily, everything's master metered with water, sanitary, of course, and sewer. But of course, all the units are individually metered for electric. Is that what you're referring to as electric being sub-metered?
Yes. I mean,
Okay.
yes. It's sorry, I must have said water. It's typically more so electrical. Usually I've asked both, and electrical is the one that matters, not water.
Got it. Yeah, that could be a huge undertaking, just getting sub meters on every unit too.
Yeah, it's expensive. So,
Yeah.
and then other things are like, do you want to find a hotel that isn't an extended stay brand, and go through the hassle of putting in the kitchenettes and plumbing the units, or do you want to just find one that's already extended stay? So those are a lot easier. So the last one we did, it already had kitchenettes in every unit. It was in Houston. Houston has no zoning. So there was no red tape to cut through to change the use from hospitality to multifamily. So that one was frankly really easy. But
What are your tenants? What kind of tenants are you attracting? Because they're predominantly all studios, right?
every one of those units is a studio. Yep. And they're
Those are
small.
tough.
They're like
Those,
300 square feet,
yeah,
350
they're
square
tough
feet.
to stay leased up. You have constant churn. At least
Yeah.
every studio we have is a churn once a year. I mean, you got a 12-month lease, and they're usually bouncing out after a 12-month lease.
Yep, exactly. Higher churn rate. This hotel is in a very blue collar area. So it's in an area called Channelview, right by the port of Houston. So target is oil workers, truckers, energy workers, people who work in the port, single mothers. We even have truck courts on site, so truckers can literally park a semi.
Nice.
We have full truck courts, so kind of interesting. But that's the target demographic.
Did you
And
keep them furnished?
Yes, we're charging a premium for furnished.
Yeah.
They came furnished, when we purchased
Right.
it, like I said, because the owner had just done all that work to put the flag on it, so they were ready to go. So we're assuming, the furnishings burn off here in 2 or 3 years, and then they'll all be unfurnished when that
Yeah.
stuff is trashed.
But you'll get 1.5 times market rent on the furnished. You should be, right? If it's 1,000, you're getting
Yeah.
1,500.
I think in our pro forma, in our starting rent, we're advertising right now $750 plus $150 utility package fee. And then, yeah, if it's furnished, then we can charge a couple of $100 extra bucks.
Yeah, I think you're leaving money on the table.
Probably. I think once we're not fully stabilized on that one. So once we get there, I think we'll start getting more aggressive.
My experience so far is that we're never going to be stabilized, and that's driving me nuts.
Really?
Yeah, it's just, I mean, we're getting leases. They're 3 to 6 month leases, but now we've got to constantly lease and lease and lease. It's still operating as a hotel on one end to fill the gap, but I mean, it's 144 units of a lot of traveling nurses, a lot of GE interns, a lot of students, a lot of business travelers they're on leases, but the leases come to an end 3 or 4 months, 6 months, and then you just got to keep leasing them up.
Yep. You should look into Cosign. Have you heard of Cosign?
I've not.
So they're a lease guarantor. We just partnered with them. So tenants who don't qualify for the income qualifications or credit qualifications for the property can go to Cosign. They'll pay them a premium. Cosign's backed by these big insurance cos, and they will sign on the lease for that person. And then if the tenant defaults, we start the eviction process. And we have so many months based on how much premium the tenant had paid, where cosign is paying on the lease
Okay.
while we're doing the eviction. So yeah, our experience has been similar to yours. Leasing velocity had been slow, so we just partnered with them. So we're hoping that you wouldn't want to do that with your entire mix, obviously, because naturally you are going to get a higher percentage of defaults if you did that with your entire unit mix. So, but 20% of your unit mix and able to lease those units up quickly because it's so hard for folks with bad credit or low income to find a roof over their heads.
Yeah,
So that's
we
one you
use
could look into.
Obligo out of Appfolio. We use them. Of course, they're to guarantee the deposit. If they damage anything, or like you said, just break their lease. But we'll look into cosign. I think it's more of there's definitely a need for the midterm housing, extended stay type of deal. There's definitely a huge need. It's a totally different type of marketing though, versus what the rest of our company's set up to do. And we've got a great base on lead flow coming in, but it's just the operations are so much heavier versus your apartment communities.
Yeah,
So it could
definitely.
possibly be
That's
our,
the struggle.
yeah, I mean, we haven't sold anything in our portfolio, so this could be the first property we're going to sell next year. It's going to be a
Yeah.
nice property for sure, but it's just operations are so heavy.
Was yours a heavy renovation to get it converted?
They just the ownership group before us, and then I think before them, just totally ran property into ground. So just total negligence on anything maintenance related. So we're going through each unit, just getting everything back up to what market standards should be, with HVAC units, plumbing, just everything, outside, interior, just
Are
total
they
neglect.
PTAC units or are they?
No, they're actually a forced air. Every unit's individually forced air, HVAC and furnace, water heaters in every unit.
Oh,
Uh,
really?
yeah, it's 20 total buildings. 18 of the buildings have 8 units. So I mean, it's a massive community of an extended stay. Just really cool property. So it can
Cool.
definitely serve as multifamily, but again, its operations is so heavy.
Yeah. Yeah.
So.
Hopefully you get over that hump.
I mean, I think we're already there. We are, but it's just like the operations don't slow down.
Yeah.
You just
Intensive.
constantly need new attention, a new guest coming in or a new lease coming in. It's just everything's times two.
Yeah. I mean, to that point, so you're going to need, so anybody listening to this who's underwriting a hotel to multifamily conversion, like take into account what Josh is saying for payroll, like probably double your payroll budget you're thinking.
For sure. Yeah.
On our OPEX, we're close to 50% on any of these hotel to multifamily conversions we're underwriting because, yeah, they are heavy on the expense side.
I would do it even heavier on your first year. Your second year, where you get more stable.
Yep.
I mean, that's with anything multifamily, though. Your first year is a write off, burn off, anything that's coming into the bank, put it right back into it. And
Yep.
second year on your second lease, usually you get your market rate on your second lease, anyways, with your increases. So.
Yep.
But very cool. Any learning lessons that you've learned along the way that you can pass on to the listeners?
In what regards?
You wish you knew then what you know now.
This might be totally unrelated, but I mean, one lesson that has recently occurred to me is don't be afraid. I've had this concept in my mind of save face with brokers. I can't offer too low because it's embarrassing to make an offer below the pack, on a call for offers. And I don't want to burn my relationship with this broker or look stupid, for coming in really low. And I'm rewiring my brain on that one. I think that's true to an extent, but you have to underwrite to what you can raise on. Your investors, what returns that they're demanding. And I've been pleasantly surprised in the past couple of weeks making offers that I felt that I was frankly embarrassed to submit to the broker. And they're like, well, actually, you're not far from the pack. You know what I mean? So I would say that's just an interesting learning lesson I've learned as of late. but yeah, there's hundreds of lessons I've learned over the last 2 years.
Just the good old NOI will set you free. Underwrite on the
And
NOI, and you're in
NOI will
positive
set you
cash flow
free.
day one.
So yeah. And I guess another lesson is you've got to go for volume. Don't get married to like a deal that a broker sends you off market, and take a month underwriting this deal, and you haven't even really got a ballpark idea of what seller would accept. So now my first question on every deal is like, where does the deal get done here?
Yeah.
And then and then I can do a quick back of the napkin and tell pretty quick if it's going to work or not. And
Yeah.
do not get married to deals, like especially syndicators who are just starting off. Like they tend to hyperfixate on the first couple of deals they underwrite. Like do not do that. Like there are so many deals out there. So if you ever feel like you're in your pro forma and you're having to tweak things and get really aggressive to make the numbers sing, just scrap it and go find another. Like it's not worth it. There are so many deals out there to underwrite.
Yeah. If a broker says it's off market, immediately ask for what's the pricing guidance, and that'll tell you to pursue it or not.
Yeah, I always ask, what's the guidance? What's the going in cap rate based on the seller's T12 and that guidance? And a lot of them don't even answer those two questions. So probably because they know their property's overvalued.
Yeah, totally agree. Cool. If a listener wants to get a hold of you, learn more about yourself, possibly invest along with you, how can they reach out and get a hold of you?
My Calendly should be on my LinkedIn profile. Go and just book me for a call.
Awesome.
Yeah, connect on LinkedIn. I love LinkedIn because I get to see what everybody else is doing. So yeah, just send me a message.
All right. Very cool. Mitchell, we'll definitely appreciate your time. Look forward to following you. Thank you.
Thanks, Josh.